Hey, good morning, everyone. Marty Mazzora here, November 13th, 2021, with your weekly macro update. Got a lot to cover this morning, so I'm just going to jump right in. On your screen is our graph of our proprietary index. It was flat week over week with a score of 20.83. We are still in expansion territory according to our assessment, although growth has been slowing of late, and that's consistent with the data, other indicators, other economic indexes, and so forth. But I'll say it again this week, we're a long ways from recessionary conditions. However, that said, we have to remain very cognizant of the fact that to get from here to here came with an absolutely phenomenal amount of government support, to the tune of nearly $6 trillion from the US, 2.2 trillion from Japan, 1.6 trillion from Germany, 900 billion the UK, same for Italy, 2/3 of a trillion from France, 1/3 of a trillion from Canada, and so on. So folks, an absolutely previously unfathomable amount of, we'll call it, support to their respective economies. And if you believe that equity prices, for example, are a signal of things to come, you would think that the market is discounting more of the same. Well, as you might imagine, that would not be discounting reality. If you look here also from the International Monetary Fund, this is the projected fiscal drag as a percent of GDP across these countries. So we had this huge fiscal impulse slash spending in 2020 and some carryover into this year, 2021. This is the fiscal drag we're looking at for the US next year. This is Japan's, this is the UK's, and so forth. So, folks, we have to think about that in the context of, is there something to offset that? Well, that's where these spending packages come in. That's where the infrastructure package that just got passed, and I think the certain to pass big spending package that looks like $1.75 trillion from the Biden administration. But when you look at the impact of that and you look at the backloading of it, no, it's not going to be more than probably a marginal impact on this. So what other things might offset this in terms of just economic activity? Well, the U.S. consumer is supposedly sitting on about $2 trillion in savings that many economists believe is very bullish for the economy next year. So you take the new spending packages, you take the consumer savings, assuming that that's going to get deployed. The question is, how much of this do you make up, and do we need to make all that up? To a great degree, this flies in the face of our inflation thesis, at least in the short run, but we have said we expect inflation to come off the boil in the short run. But I still think we're going to see a higher inflationary regime going forward. The question is, how are markets going to respond? How is the equity market going to respond in the year two of the election cycle, which typically isn't great for markets historically, against this fiscal drag? And so that's something to be very aware of, and probably something that should inspire investors to hedge their portfolios going into next year. Okay, to the inputs to our index that I wanted to share with you today. A negative input was consumer sentiment. So again, I just talked about all this consumer savings, and I think it demands some consumer optimism for that to be aggressively deployed into next year, but we'll see. But the University of Michigan survey that came out Friday is very concerning. As you can see, it dropped all the way to 66.8, and that takes us all the way back to 2011. So that's not a good look. The Langer Weekly Comfort Index has been rolling over of late, although you can see we did get a little bit of an improvement here this last week. And the conference boards, we got an improvement last month, but this month has yet to come out. So pulling right from yesterday's release of the University of Michigan survey, it's really inflation. Inflation expectations rose another 1/10 to 4.9%, which is the highest since July 2008. They ask, is the government doing a good job on inflation and unemployment? That answer fell to a 7-year low. So not so much in the eyes of consumers. Is it a good time to buy a vehicle? That fell 10 points to 49. That's the lowest level by 20 points on record. And this survey started in 1978. Is it a good time to buy a home? That declined by 15 points, which is the lowest since 1982. And that's when mortgage rates were dramatically higher. Wanting to buy a major household item, that fell by 7 points, the lowest since 1980. So again, we're talking about couple trillion in savings getting deployed next year, but we have consumers, at least in this survey, saying they're not in the least bit eager to go out and spend a bunch of money. From the report, to kind of sum it up, and I'm borrowing, by the way, from Peter Bookvar's notes, who he did a pretty good job of breaking it all down for us. Consumer sentiment fell in early November to its lowest level in a decade due to an escalating inflation rate and the growing belief among consumers that no effective policies have yet been developed to reduce the damage from surging inflation. 1 in 4 consumers cited inflationary reductions in their living standards in November, with lower income and older consumers voicing the greatest impact. Nominal income gains were widely reported, but when asked about inflation-adjusted gains, half of all families anticipated reduced real incomes next year. Wow, that really flies in the face to much of the bullish narrative that people are forwarding going into next year. So again, things to watch out for, things to be concerned about, things to compensate for in portfolios, if only through just hedging big downside risk. Okay, and then staying on sentiment, the NFIB Small Business Optimism Index came out last week, and we track 3 components in our index. It's the overall optimism, which is what's here in front of you, hiring plans and CapEx plans, and both hiring plans and CapEx plans picked up, but the overall optimism index actually declined to 98.1. Historically, it's not necessarily terribly low, right? But relative to where it's been of late, it certainly is on the decline. And here I'm going to borrow from Bespoke Investment Group's weekly note. According to the NFIB survey, the question is your single most important problem the cost of labor or the quality of labor? Cost of labor is the dark blue, quality of labor is the light blue, and you can see how high those two are historically for this index. That's very problematic according to small businesses. How about inflation? Is that your most important problem? That rivals the big energy spike just ahead of the great financial crisis in 2008. The good news is the question, is your single most important problem poor sales? The answer is no. You got a 5 there, and that is historically low. So while we have these concerns, while we have this plunge in optimism, vis-a-vis the consumer, as well as, small businesses, the outlook for sales, right here is pretty good. So the small businesses are assuming that the consumer's pocketbook is going to be the deciding factor, not necessarily what we're reading at this point anyway in the consumer surveys. Next up, the U.S. Economic Surprise Index done by Citigroup. That's actually inched its way back into the positive. As you can see, economists from the peak were way over optimistic relative to reality. And then, of course, that reality brought them into more of a pessimistic mode, and we're now inching back into positive territory. So that one scored a positive on our index. And again, that's data coming out better than what economists had predicted. I showed you this during the week when I did the video where I touched on inflation and this week's inflation prints. This is the tips break-evens. We do track this in the inflation component of our own index. This shows the 2, 5, and 10-year inflation compensation or market expectations based on the difference between the yield on Treasury inflation-protected securities, or TIPS, and the yield on the regular nominal bond. And you can see we're looking at really all-time highs in terms of inflation expectations discounted in the bond market. What's really interesting, though, is the huge decline in the Baltic Dry Index, and this is really worth talking about here for a minute. So the Baltic Dry Index reflects the cost of shipping dry bulk goods across the world's oceans. Well, that relative to recent history is still a pretty high level. It's way, way off of this high, right back up in here. Libra Shipping in London attributes this big decline primarily to concerns over the health of the Chinese economy. That, according to them, has led to a sharp decline in the dry bulk sector. What's interesting, though, despite this big drop that we see here in the Baltic Dry Index, when we look specifically at agricultural commodities, which are definitely a not small exposure for us in our core portfolio, we continue to see very high shipping costs. This is the IGC Grains and Oilseed Freight Index, according to our partner BCA Research. And, again, it's come down a bit, but, it hasn't retraced 50% of its rise like the Baltic Dry Index has. And speaking of agricultural commodities, given the doubling of natural gas prices and export controls implemented recently by China having to do with phosphates, for example, and threat, as I read yesterday, from Russia to kind of withhold exports related to fertilizer inputs. The cost of fertilizer is soaring as we speak. Here's a look at the Green Markets North America Fertilizer Price Index, right? So we are looking at essentially, I'm sure, all-time highs, certainly higher than the big spike in 2008. And therefore, on top of several other reasons, we remain quite bullish on the ag complex, certainly for the foreseeable future. And just to run through some other data points that came out over the last week, some of them are inputs to our index, some aren't. And for example, mortgage purchase apps were up 2.7% week over week. Number of refinances last week rose 7.4%. The JOLTS job openings number came out. That's also in our index. 10.4 million. It was essentially the same as the previous month. The quits rate rose to a new high of 3%. I've shown you that recently. And the theory there is if people are willing to quit their jobs, things are pretty good out there, because people don't generally quit unless they have something either better waiting for them or they anticipate better opportunities as they go out and hunt for another job. Across the water in Germany, the ZOO Confidence Index actually rose notably to 31.7 from 22.3, way better than what was estimated. And we did just add a Germany index ETF within the last few weeks to our core mix. So it's their outlook that they're very optimistic on. Current conditions, they're still pretty pessimistic. And I'm a bit concerned with what we're seeing in COVID spikes throughout Europe. Those numbers are starting to look concerning, and we're actually beginning to see a little bit of a rise here in the US as well. So we have to pay close attention to those COVID numbers on top of everything else. Chinese inflation on the CPI end, on the consumer end, actually was pretty tame, 1.5%, which is in stark contrast to their producer price index, which actually rose 13.5% year over year. And make no mistake, energy prices are a huge issue right now across the Chinese economy. So folks, that's plenty for one report. So much out there to cover, so much that we're paying attention to as we navigate these uncertain waters globally on behalf of our clients' portfolios, and is also why I communicate so often, just to kind of keep you abreast of what we're seeing and what we're thinking. And so I'll leave it there. I hope you have a wonderful weekend, and I'll talk to you again very soon. Take care. Bye-bye.